Hello, I'm Julien Waro. I'm the head of the Energican platform at ENGIE Global Markets here in Paris. So thank you for being here. This is a presentation dedicated to the last trends and events impacting European energy markets. So we have a lot of things to deal with today. So this is a presentation that will have two parts. So the first one on the European situation, so global view on fundamental of gas and power markets, and then I will have a specific focus on the UK. So this is a presentation for you for the B2B UK supply business, but you can use the material for your clients, of course. And I open the Q&A mode, so you can ask some questions at the end of the presentations if you have. So let's start with first, before moving to the energy part of the presentation, just a comment on the macroeconomic environment. And what is clear is that Europe is heading towards a recession, mostly because inflation continues to accelerate, and we will probably reach double-digit rates before the end of the year. So this is clearly historical. We have never seen this kind of inflation rates for almost 40 years. And the thing is, central banks have clearly revised their outlook. So they do not consider anymore that inflation is temporary. And so they are increasing interest rates at a huge pace, as you can see in the chart, in the second chart in the middle of the screen. And they intend to keep those interest rates at high levels until inflation starts to decline. And of course, the sharp increase in energy prices is one of the main driver of this inflation rates. And overall, if you look at the forecast in terms of GDP growth for the main economies, you can see that the Eurozone, the UK, and the US have seen a sharp downward revision in terms of growth, and clearly we are moving towards the recession territory for the coming quarters. And you can see that the UK is particularly hit, both in terms of inflation, with an inflation rate which is significantly higher than the euro area and the US, and in terms of GDP growth, it's also worse in terms of outlook in the UK. Maybe it's linked to the fact that the retail energy prices increased quite significantly in the UK compared to the rest of Europe over the past few months. So let's move on to the energy part of the presentation, and so I will not be long regarding prices. We all know that energy prices, gas and power mostly, have increased in an unprecedented manner over the past few months, and we have reached clearly unsustainable levels for most of the global economy in Europe. So here you have the UK benchmark, so the NBP month-ahead price, the UK power month-ahead baseload price as well. And you can see that compared to the beginning of 2021, NBP prices have been multiplied by 10 at the peak of August, and power prices followed suit, of course, given the dependency of natural gas regarding UK power generation. What is interesting to notice is that if you look at the oil market, so the Brent first nearby, overall the increase in oil prices is not so impressive compared to the beginning of 2021. Yeah, it's mostly linked to several factors, such as the fact that there is a cartel of producers who are able to increase production in a coordinated manner. I'm talking about the OPEC. The effect of the recession, of the coming recession, is also much more acute on oil prices. And we may also remind that there are some strategic stocks of crude oil in most developed economies. And these stocks have been used a lot over the past few months with sharp stock releases in the US and in Europe. It also weighed on prices. It's not the case for natural gas. So in Europe, for example, only Italy as a strategic gas stock reserves. It's not the case for most of European countries, even in the US. So that's also an explanation of this sharp increase in gas prices compared to the oil market, for example, over the past few months. And one last comment on the EUA, so the CO2 price. So the UKA price is still strongly correlated to the European benchmark. And you can see that overall the price of CO2 in Europe did not increase a lot compared to power and gas, and it even dropped quite heavily over the past few days, notably due to the effect of the coming recession on global economic activity, so consequently on CO2 emissions as well, and also the fact that clearly in this troubled period, it's quite difficult from a political point of view to push for higher CO2 prices when inflation rates are extremely high, power prices as well. So clearly there are some, even if there are talks in Europe to revise the emission trading scheme and to make it more even tighter in the coming years in terms of supply. In the short term, there are talks to sell a lot of CO2 allowances in Europe, notably to finance the Repower EU plan, and also to ease the financial burden on households and businesses regarding their energy invoices. So that's why you have this disconnection at the moment between power, gas, and coal prices on one side, and, for example, Brent oil prices and CO2 prices. So let's go deeper into details. And just before we start on the short-term fundamentals, just one comment on the origin of this crisis, because clearly we are living the worst energy crisis since the first oil shock in 1973. And just a quick look back at what happened 50 years ago. Just looking at, for example, the European gas market. If you look at what was the situation before this first oil shock, you can see on this chart that production and demand of natural gas in Europe were closely correlated, and even all the gas that was produced at this time was consumed in Europe. And then after the first oil shock, when Europe found itself short in terms of oil supply, and oil was used in all parts of the economy, for residential and commercial heating, for electricity generation. It was used in the industry, of course. And so we started in Europe to invest a lot in natural gas exploration, especially in the UK, in the North Sea. But we also shifted a lot of oil consumption towards natural gas. And that's why we see a sharp increase in gas demand since this first oil shock. Production started to increase as well, but not at the same pace, clearly. So it's led to a sharp increase in gas imports. It also launched the LNG market, and so if you look at the situation before the Russia-Ukraine war, you can see that the dependency on imports, and especially on Russian gas and LNG, was really significant in Europe, with less than half of total gas demand satisfied by domestic production in Europe. So clearly, what happened 50 years ago is impacting the current situation, and we could have the same reasoning regarding power. For example, in France, we decided to launch a massive nuclear program just after the first oil shock, and today we have a lot of issues with our nuclear plants, and these problems have roots on this first oil shock. So that was just an historical reminder, so we can move towards the future. And as I mentioned, Europe has a growing dependency on energy imports. We will have more details in the coming slides. But the problem is this sharp increase in European energy demand comes at a difficult time for the energy industry, mostly because if you look at all the liquefaction capacities under construction at the moment, you can see that until 2025, it's quite limited in terms of additions. So I just took some numbers for the past 5 years, and you can see that between 2017 and 2020, we have 44 BCM per year of LNG liquefaction capacity additions, so mostly coming from the US. And here we are in the low part of the cycle, clearly, with only 15 BCM on average between 2021 and 2024. You can see that some volumes were expected to come from Russia as well. So clearly, those volumes will not target Europe. And we don't see an acceleration before 2025, mostly with a lot of volumes coming from the US, from Canada, and also from Qatar, with a massive expansion of Qatari energy capacity. So clearly, we have not a shortage, but we have a huge tension on the LNG supply until 2025, and Europe, and the sharp increase in European energy demand is coming clearly at one of the most difficult time for the industry. And so if you look at the numbers in terms of supply, clearly we see that Russian pipeline exports dropped a lot. I won't come back on all the recent news regarding Nord Stream 1 notably, but what you can see is that the market share of Russian pipeline flows across total European gas supply dropped significantly from 1/3 of total gas supply last year to just 11% of total supply over the past 2 months, and probably much lower in September with the shutdown of Nord Stream 1 for an undefined period. So we still have some Russian gas flows coming through Ukraine, but clearly the share of Russian flows on the European gas balance is low now, very low. So the leverage for Russia regarding regarding gas flows to Europe is clearly much more limited now, and we see that with demand destruction occurring at the moment across industries and also residential and commercial heating, we see that the balance clearly shifted across Europe. And of course, at the opposite, if you look at LNG imports, the share of LNG jumped a lot notably to offset this drop in Russian pipeline exports to Europe. And now LNG is representing a third of total gas supply in Europe. And what is interesting is to look at the origins of this LNG imports, and you can see clearly that almost half of total LNG volumes imported into Europe are coming from the US. So the dependency from Russian pipeline exports shifted and moved towards US LNG exports over the past few months. That's a major trend, and it means that what happens now on the US gas supply can have an impact on European gas markets as well. That was clearly not the case a few years ago when US LNG exports represented 10 to 15% of total LNG supply in Europe. So regarding the demand side, what we see is clearly an acceleration in terms of gas demand destruction across Europe, and mostly in the industrial sector. And the figures are quite impressive because you can see that last winter we estimated that demand destruction was around 10 to 15% of total industrial gas demand across Europe. And now we are close to 25% on average. And you can see here the sharp drop in industrial gas demand across Europe. It's clearly linked to the surge in gas prices. And we see that energy-intensive industries are particularly hit. So in the next slide, there is an illustration of the fertilizer industry, which consume a lot of gas in its industrial process. And you can see that most of fertilizer capacity is shut down across Europe. We are talking about 70% of total capacity. It's huge in terms of consumption. It represents dozens of million cubic meters per day less in terms of gas demand across Europe. Just to give you an equivalent for power generation, we will see in the next slides that gas demand is power demand, and demand destruction is much more limited than gas so far. But we see a lot of news of smelters to produce aluminium, notably, that are closing down their activities as well in Europe. Notably because power is their essential feed cost to produce aluminium, and power prices are much more above the break-even of those plants and factories. And if you look at aluminium prices, for example, they are much more sensitive to the coming recession as well. So aluminium prices are relatively stable or even dropped over the past few months, while electricity costs jumped to the roof. And that's a key issue for all this energy-intensive industry across Europe. But industry is suffering, of course. But if you look at households and SME, it's also starting to drop significantly. So you can see here the European average local distribution zone gas demand. So it means residential and commercial users and some industrial users connected to the distribution network. So when I was talking about heavy energy-intensive industries, I was talking about industrial users connected to the transportation network. If you look at the distribution network, the drop is estimated at 5% over the past few months. But we know that retail tariffs are due to increase significantly across Europe. In the UK, with the increase of the retail price cap by 80% on October 1st. In Germany, we have the German gas levy, so an extra tax on retail gas and retail gas invoices to finance the emergency measures to support the sector. So maybe we could have something like a 10% drop in retail gas demand this winter. So that's one of the assumptions. It's clearly difficult to assess it exactly, but clearly we expect an acceleration in gas demand destruction in this sector in the coming months. And finally, the only sector where gas demand remains high is power generation. And you can see here that gas demand from CCGTs increased significantly over the past few months. And it's due to two main issues across the European power generation sector. First is the sharp decline in nuclear generation. So you can see, next slide, that nuclear power generation is extremely low, at record low levels for this time of year, especially in August. So it's linked first to the stress corrosion issue detected on the French nuclear fleet last year. So it's impacting a certain number of reactors, and it's limiting French nuclear generation for almost a year now. And this year, we also had an historical drop across Europe, which has led to a sharp drop in hydro power generation. You can see here on the left chart. It also had an impact on, for example, coal transportation by barge, especially in Germany, as the Rhine water level was extremely low. So it led to some disruption to supply coal to thermal plants. It also led to some disruption in France, notably because some nuclear capacities had to be shut down temporarily due to low water levels and high temperatures on rivers bordering the plant as well. And so with August was also very calm in terms of wind power generation. So that's why we had such an increase in gas demand for power generation in August, and close to record highs for this time of year, despite gas prices trading at historically high levels. So that's clearly one of the, I would say, the main concern for the next winter period is the low nuclear and hydro generation availability, combined to issues on gas supply availability as well. But if you are looking for some positive elements, there is a big one, is the fact that if you look at European gas stock levels, we are a bit above the historical average for this time of year, with a fullness rate above 80% at the end of August overall across Europe, with some countries close to full capacity, for example, France or Poland. And this is 2 months earlier than expected, 2 months ahead of the official European Commission target, which was to reach 80% fullness rate at the end of October. So that's a positive sign. And of course, with almost zero Russian gas flows expected this winter, it may be not enough to cope with a very cold winter period. And that's why demand destruction will be a key element in balancing European gas markets in the coming weeks and months. So that's all for the European view. So let's move on to the UK to look at specific drivers in the UK market. And I propose something a bit different than what we do generally. I found this tweet from the UK Energy Minister when I was preparing this presentation, and that was an update on energy security for the coming winter. And I thought it was interesting to look at the assertions of the minister and to see if it's confirmed by our own data. Let's take the first one. North Sea gas production up 26% this year. Yeah, if you look at UK gas production in 2022, it's clearly close to record highs for the past 5 to 6 years. And it's mostly linked to a maximization of existing capacity. In this market context, it's not surprising, because if you look at the new production capacity expected in the coming months and years, it's quite limited so far. I just noticed the Jackdaw gas field with a final investment decision announced by Shell this summer. So it's a relatively big field with something like 9 million cubic meters per day expected in terms of production, but not before the second half of 2025, so in 3 years. But it may help the UK to keep production level relatively stable in the coming years. Let's take a second assertion. So we see 137 LNG cargoes received this year, up 48% on last year. Yeah, if you look at UK LNG imports, clearly we are in a record year in terms of LNG imports. We will see in the next slide that it doesn't really benefit the UK, but mostly Europe as a whole. And it's linked to the fact that the storage capacity in terms of natural gas in the UK is very limited. So coal plants remaining online. So we are talking about power generation here. And clearly, in terms of power supply, the balance is very tight in the UK for the coming winter. And coal will play a key role in maintaining the stability of the power system in the UK. Even if you look at this chart, if you look at coal-fired capacity, you can see that it has dramatically dropped over the past few years, especially for environmental purposes. So installed capacity is now limited to 1.5 gigawatts, but several units will come back to the market or will be maintained as contingency assets. So we are talking about 2.44 gigawatts. So that's huge in terms of capacity additions compared to existing capacity at the moment. Next slide, approval to open the Rough gas storage site. So yeah, as I was mentioning, the UK gas storage capacity is clearly limited. It's only 2% of annual demand at the moment. If you compare to France, we have something like 27% of storage capacity compared to annual demand. And with the major swings in terms of gas demand between the summer and the winter period, 2% is very low. So that's why you can see on the chart below that the UK relies on imports from the continent during the winter period to cope with high gas demand. But if you look at the situation over the past few months, you can see that the UK exported a lot of gas because the UK received a lot of LNG, and as the storage capacity is very low compared to demand, much of this LNG was re-exported to the continent to be stored within European underground storage sites. So ROF is back. So ROF was mothballed in 2017, mainly for security issues. And so Centrica was granted a permit to store only 0.8 BCM out of the 3.4 BCM of technical capacity. So it's not clear if ROF can be filled before the startup of the heating season in the UK. But 0.8 BCM compared to only 1.5 BCM of existing capacity, it's something like a 50% increase in storage capacity compared to the installed capacity. So that's huge, and of course that could help the UK to be balanced in terms of gas supply in times of peak gas demand. And one last comment regarding this huge exports in terms of natural gas to Europe. It's also linked to the fact that the NBP spot gas price is much lower than continental figures, especially the TTF, and it's clearly linked to this huge increase in LNG imports in the UK, and the fact that the storage capacity is low. So that's why the NBP is trading 2 times lower than the TTF. So that's really impressive. That's clearly an unprecedented situation on the European gas market. And one last assessment from the UK Energy Minister is the fact that 8.6 gigawatts of renewables are being built now. So I just had a look at the average yearly capacity addition in the UK regarding renewable energy sources. And you can see that on average over the past 10 years, we were at 3.7 gigawatts of new RES capacity. So 8.6, it's quite huge, and it's quite huge compared to the last 2 years, where we had a clear deceleration in terms of RES capacity additions. So that's clearly a sign that renewable capacity is expected to increase significantly, with also national plans to reach high targets towards 2030 or 2050 for wind and solar power generation in the UK. So let's move to the power situation in the UK, with clearly a lot of concerns regarding the next winter. So you may add a look at the National Grid Winter Outlook that was published in July. So we know that we will have an update in October, but National Grid provided an extraordinary report this summer. And it's really interesting because if you look at this chart, so you have the technical capacity, power capacity in the UK. So we are at 110 gigawatts of installed capacity. But you can see that almost half of this capacity is renewable generation, so intermittent generation. And so here you have the balance for the peak of the winter period. So with here an estimation of an average cold spell ACS peak underlying demand. So you can see that you are close to 60 gigawatts of power demand at for example at the end of the day in December, when the temperatures are below normal, and much of the solar capacity is off, and you have a low wind generation, for example. So this is what you can see here in the derated generation capacity. So clearly an estimation of available capacity at these times of peak demand, and you can see that the margin is at 4 gigawatts. And what is interesting in this report, first, is that if you look at these 4 gigawatts, it's mostly interconnection with Europe. And if you look at the assumptions of National Grid, there are 3 assumptions that are a bit dangerous from my point of view. So clearly, they assume 5.7 gigawatts of imports when needed. So clearly, depending on the situation on the European continent. They also assume that gas for CCGTs is available. And they also assume that on the tightest days, the UK price, the UK power price, will be above Europe, which will move power flows from Europe to the UK. But if you look at, for example, the forward curve as of Monday's close, you can see that the UK in blue is trading well below France for Q4 22 and Q1 23, and even below Germany for Q1 23. So clearly, it's not sure at all that the UK will receive as much power as expected in times of peak demand. And one positive assumption here is that National Grid did not take into account the contingency coal assets. So we talked about 2.4 gigawatts of contingency coal assets. So clearly, they will play a key role if we have a cold winter period in the UK, because interconnection and cross-border flows with Europe may not be there as expected to balance the UK power system. So regarding the power situation in the UK, what is quite interesting, just looking at demand, is that so far we don't see a real demand destruction trend. So we can see here the 2022 average power load in the UK compared to the historical average. And you can see here you have the 2021 figures in purple, and you can see that 2022 is more or less in line with 2029, 2021 for the summer period. So clearly, this is not really positive, because we may need much more demand destruction in the winter period to cope with this tight supply picture. So one comment also on the French nuclear situation. It's clearly shaking up all the power flows across Europe. So we were talking about the need to import power from Europe to the UK in times of peak demand. And if you just look at the flows at the moment, the imports of power from the UK to France, you can see here that in 2022 they increase a lot. And they are at available capacity. At the moment, the interconnection capacity between France and the UK is at 3 gigawatts. It will increase to 4 gigawatts in the coming months. But today, on certain days, France is importing as much power as possible from the UK. And you can see that the trend in French power imports is clearly different from previous years. If you look at cumulative net power imports, so we see that we are in deep negative territory in France. And it means that France used to be clearly a big power exporter, and this year is totally different. France is a net power importer and is importing a lot of power from the UK. So don't expect a lot of French power exports to the UK in times of peak demand this winter, except if EDF manage to realize its availability outlook which so far has not been the case at all. You can see here in red the nuclear French power generation from nuclear plants, and you can see here the dotted blue line is the REMIT availability forecast. You can see that it's relatively optimistic for the end of the year. We were in the upper part of the historical range for December. If you sum the realized nuclear generation and the blue dotted line for the expected availability, you have an annual nuclear generation figure at 308 terawatt-hour, which is above the official production target announced by EDF, and they announced a production range between 280 and 300 terawatt-hours. But recently, they communicated that the 22 figure should be much closer than 280 rather than 300 terawatt-hour. So we know that this blue dotted line is really optimistic and won't be realized probably. So that means that French nuclear availability should remain low or even historically low in the coming months, and this will continue to tighten the European power balance this winter. So it's time to conclude these presentations with the key takeaways. So just to sum up, the ongoing crisis is the combination of three main factors. So clearly the Russia-Ukraine war leading finally to the halt in Russian gas flows to Europe, almost complete halt. There are still some flows coming from Ukraine. We also have this combination of record low French nuclear generation due to the stress corrosion issue and the historical drought cutting hydropower generation, and also leading finally to poor hydro reserves for the upcoming winter. So in terms of outlook, the interventions of authorities is clearly unavoidable, and it already started. But I see three points really important in terms of intervention, of regulatory and policy interventions. So they need to reduce energy demand to ensure the physical balancing this winter. Also, interventions to ease the financial pain for end users to avoid a massive recession. We know we are heading to this recession, but maybe it's possible to limit its impact, and mostly for energy-intensive industries, which are clearly at risk of relocating their production elsewhere. And I'm talking about the fertilizer industry, the aluminum industry, the steel industry as well, which are clearly suffering at the moment. And last point, last but not least, we see that we have a huge liquidity issue on energy markets across Europe. You may have heard about the Uniper bailout, and also about the credit lines of billions of euros granted by states to their local utilities over the past few days in Sweden, in Finland, in Swiss yesterday. So in Switzerland yesterday. So it's really a huge problem. So the next step, which is widely awaited, is the extraordinary European Energy Council on Friday, on the 9th of September. It will be followed by the European Commission President States of the Union address next week. We will also have next week the RTE, so the French Power TSO winter power outlook. So maybe some clarity regarding the French nuclear availability this winter. And in the UK, we should have the update of the National Grid winter power outlook in October, which will be, of course, widely awaited as well. So thanks for your attention. I see that we have some questions in the chat. So we'll publish. So is there a longer-term concern that our reliance on gas has just moved from Russian pipeline to US LNG, leaving us still vulnerable? No, so far, I don't think it's relatively taken into account because this is an emergency situation. But it will have to be monitored, of course, in the coming years, because the dependency on US LNG is clearly significant at the moment, and is likely to grow probably in the coming years as US LNG export capacity is expected to grow as well from 2025, and Europe should continue to attract a lot of volumes if European prices remain above Asian references, for example. So that's clearly a key element to track in the coming months and years. Another question: so do we have a long range forecast on what weather is expected to be this winter? So yeah, there are some seasonal outlooks. So the reliability of those outlooks is quite limited, but maybe we are heading towards a mild autumn, notably because if you look at the sea temperatures, we have significant anomalies in the North Sea, in the Mediterranean Sea as well, with sea temperatures much above normal levels. So it could play a key role in keeping temperatures relatively mild, but it may also lead to some violent storms across Europe in the coming weeks and months. So probably high wind power generation, but also some impacts on the economy as well, regarding floods, for example. So one last question: so do you think there will be enough gas capacity to cover the winter increase, or are there likely to be planned power cuts? So yeah, that's the key question, because if you look at the CCGT's capacity, I think we, for example, in the UK, there is a huge installed capacity. If it runs at full capacity, it will help to balance the system. But we know that that's what I showed with the derated capacity factor. For example, on average, a CCGT is available 85% of the time in the UK. So you know that in times of peak demand, you may not have all the capacity compared to what is installed, and even if you have this power capacity available, will we have the gas available, the gas supply available as well? That's the key question. But overall, if you look at the balance, for example, the European gas balance, most of the simulations show that Europe will have to reduce gas and power demand this winter to cope with cold temperatures and almost zero Russian gas flows. And note that we are also much more dependent on energy imports. So if we have a disruption somewhere at a liquefaction plant, it will have an impact on the European gas balance and power balance as well. So clearly, I think the answer is that Europe cannot get rid of coordinated reduction in energy demand this winter to balance its energy system. So thank you for your attention. I hope that this presentation was useful. I will send you the slides and a record of the presentation if you want to share it with your colleagues within the UK B2B supply business platform. So thank you all. Have a good day and keep safe. Bye.